Pizzazz over profits. That might describe the way some investors picked tech stocks over the past several years when interest rates were low and markets were high. Times have clearly changed. Question is that change permanent? Let's ask star venture capitalist Rick Heitzman of FirstMark. He led investments in Pinterest and DraftKings, among others. Was recently named to the Forbes Midas list of the world's best VCs. Here with me, as you can obviously see on set. I do want to talk to you about how times are, in fact, changing. And I want to do that by having you listen to what Altimeter's Brad Gerstner told me about a week ago on growth investing and the sea change that he sees. And we'll talk on the other side. Listen.
For those companies that are still anchored to this idea that they're going to get a multiple of revenue, right? 10, 15, 20 times sales without producing profitability, that ship has sailed. Those days are gone. And the faster both private and public companies get on board with this new orientation, I think the better they're going to perform.
You agree with that?
Of course. You must have been listening to me over the last year on here. It's the things we've been saying. It's back to basics. That free money piece of the world is over, and it may never come back. And it's back to saying, hey, you're going to be valued on profitability going forward. And how do you drive to unit economics and making your business work?
I thought the interesting thing that Brad said, too, was it's both on the public and the private side, which, you obviously, navigate both sides of that fence, right? I mean,
Correct.
It's both.
It's both. And I think the private side's always lagged the public markets. Every day you get your scorecard in the public markets, your stock's up or down, and the people react to that. In the private markets, you don't have to feel that pain on a day-to-day basis. But what you're seeing is more companies who need capital coming back to market. All of those companies are being re-rated in a much more aggressive way than you're even seeing on the public side.
Are you having these kinds of frank conversations right now with founders about the way that their businesses need to be run in the future? And how are they accepting the message, too? Because it is a definite change from the past many years.
It's an incredible change. And you've got to remember, a lot of these founders are in their early 30s. They've never seen a downturn. So they might think it's temporable, all the stages of denial. But going back to this time last year, when we were planning for 22 and what that might bring, we had to have some milestones in place. We had to have some triggers in place about how they spend money. But it was unit economics. It's back to basics. It's what does your business look like in the long term, and how are you driving efficiency, and what's your ROI on everything? Your dollar of marketing spend, your dollar of development spend, and how does that change if cost of capital increases? And we've seen, sadly, that's come to pass as cost of capital has gone up tremendously.
How's that message go over when you deliver it?
This time last year, I was like maybe more like Chicken Little. They might have called me the Chicken Little bartender of, hey, the sky's falling. We're not sure what to do. Obviously, there's initial cognitive dissonance. But what we've seen is the best founders have reacted the quickest. So there was a lot of rebudgeting in the beginning of this year saying, hey, we're going to think about 2022 differently. We're going to think about how we deploy capital differently. And we're going to, as Frank Slootman says, amp it up. We're going to be more lean. We're going to require more from our employees and see what happens. Maybe some people got the memo in Q1, and as we've seen with Meta and some of the other folks, they're just getting the memo now.
You think valuations of these high growth stocks have come down enough, or does that question still hinge on where interest rates go from here?
I think they've come down as a class. And one of the other things we've talked about over time is who are the babies that are getting thrown out with the bathwater. And I think oftentimes we talk about a whole class of 2021 IPOs or SaaS companies and those multiples, or direct-to-consumer commerce companies, and all of those companies are being viewed as the same. And I think this year, probably starting out, maybe even starting earlier this year, and definitely into next year, the key thing you look at is who are the best teams, who's really driving efficiency in their business, and who's demanding that their employees amp it up, and who are going to have the best businesses on the other side.